You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time once again for TWIFO, This Week in Futures Options, a program where we break down all of the madness happening on the other side of the fence, that futures options side of the fence. It's going to include a lot of product categories you're probably familiar with. Equities, certainly a big part of that these days, so we're going to get into that. Probably going to have some energy, probably some metals, some rates, all of those big complexes making huge, some might say historic moves out here this week. I'm going to break all that down, get your questions a lot more. I'm going to try to hold your hands, calm you down a little bit as the market continues its turbulent, aggressive move here to the downside. Pretty much across the board, the old adage, when it all hits the fan, correlation moves to one. That seems to be playing out there across the board. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting and certainly ever necessary these days, the Options Insider Radio Network. A lot to parse here on the program. Joining me to help me do that, first off, we've got our old friend beaming in on the old FTSE Russell hot seat there, Mr. Sean Smith, the Managing Director of Derivatives Licensing over there at FTSE Russell. Sean, unfortunately, we can't do it face-to-face in the studio, though, of course, these days in this cancel everything environment. Probably for the better, sir, but happy to have you back on the program this week, Mr. Sean, sir.
Mark, it's always good to be back on the show.
You know, what a difference a week and a couple of days makes, Sean. Just a week ago, you and I were sitting in sunny Florida chatting. I wouldn't say all was right with the world because things were certainly selling off last week as well, but there were still conferences. It was still able to actually go forth and meet with people and do things. Since then, of course, FIA Boca was canceled. The OIC conference, a big option industry conference, has been canceled. I just heard my little guy's flag football game this weekend has been canceled. Everything getting canceled, Sean. So what a difference it makes, Sean. Just a week and change, sir.
It's crazy times. I've got I've got twin boys in college. They're seniors, and it's looking like they're going to be one, extending their spring break. Two, they're going to be probably finishing their last semester of their senior year online. I mean, some unheard of stuff going on wherever there are groups getting together. They're trying to minimize the exposure to, possible more infection. It's just crazy times.
I guess you didn't realize you're paying all that money for homeschooling, did you, sir?
Yeah, I think I need to renegotiate the final semester and out-of-state tuition that I'm getting crushed with.
Yeah, tuition, room and board. I'm guessing all those things are not going to get any sort of refunds, even though they're not exactly getting all that. But I digress. We got a lot to get to. We'll get to it. Also, helping us get to it today, we got a newcomer joining us, holding down the CME hot seat today. He is Jeff WHITT, the co-founder of Simply Derivative. Jeff, welcome to the TWIFO program on this most auspicious of weeks, sir.
Hi, Mark. Thanks for having me. It's a pleasure to be here.
And Jeff, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give our audience a little bit of an overview of your background in the derivative space, as well as what the heck it is you guys do over there at Simply Derivative.
Yeah, absolutely. I'm basically a full-time trader in the futures markets, options, equities, but we primarily focus on futures and futures options. I've been trading for over 12 years now. Prior to that, I had dipped my toe in the advisory business at some of these big firms like a Morgan Stanley and a Merrill Lynch. But as of 3.5, 4 years ago, we ventured out on our own, and I started Simply Derivative as a way to share our trading journey with other retail traders out there looking to understand the markets, how they move, why they move, and where they may move next. And, that's kind of what we do on a daily basis. We day trade the futures. We take opportunities when they come along in the options market. And, we share this journey with our members and anybody looking to get into trading.
Now, before we get into what's lighting up, and certainly a lot is lighting up, I'd be remiss if I didn't address it here, especially on this show. You are coming at us, Jeff, from the CME Group hot seat. CME making some rather historic headlines this week, taking the unprecedented step of actually shuttering their trading floors, just announced yesterday in an abundance of caution ahead of all things coronavirus. They are pretty much shutting down the trading floors, and it is an open question as to whether we will ever see those floors reopen, and it's no secret CME has been trending that way for a while. Globex has been taking up a larger and larger share of their ADV pretty much every month, but still, it is kind of a surprising thing. I know, Sean, you were a member there. Jeff, you obviously are trading these products out there on a regular basis, so this is probably interesting and or surprising news to all of us. Maybe, Sean, I'll just start with you really quickly. I just want to get your reactions to that as a former CME member and your thoughts. Do you think we'll ever see those floors reopen, sir?
I have to tell you, I spent many years, probably close to 15 years as a floor trader on various floors around the country. In New York on the American Stock Exchange, on the floor of the New York Stock Exchange. I actually started in the business on the Philadelphia Stock Exchange trading floor and spent several years prior to moving upstairs on the CME floor. I was in the Eurodollar pit I have to tell you, the liquidity back in the day of massive open outcry was an incredible place to find price discovery and liquidity. But, the markets went electronic, and options trading still in its complex nature has remained in the open outcry forum. And because of those complex trades, I'm wondering how they are going to manage. But I think for the safety and security of, all the people involved, it's probably a very prudent move by CME Group to make this drastic move. The liquidity in the Eurodollar complex options is massive. I think, Mark, you and I talk about that every single show, how a single option can trade in the hundreds and hundreds of thousands of contracts. Actually, over 1 million we saw in a couple of contracts not too long ago. But I'm not surprised. I think that this country is taking some very, very drastic moves to try to minimize the spread of this infection. I think that's it. I'm just not surprised.
Jeff, same question for you. I'm not sure if you spend any time as a member down there on CME, but obviously you're trading a lot of their products right now. I'm curious your thoughts. Sean kind of just hit on it. There are still a lot of complex transactions, particularly in the equity option space, that like a little bit of that high-touch execution there on the floor, like to be worked on the floor. Of course, Eurodollars is still a thriving big pit. Even some of the ags and things still have a decent floor execution component to them. What are your thoughts on this fairly historic closing, and your thoughts on whether we'll ever see these pits reopen in our lifetime, sir?
Yeah, no, just to Sean's point, I'm not surprised that we've seen them shut the floor down for now. And you saw this, all over the country, particularly yesterday with the NBA canceling the season. The other major sports are coming out and canceling tournaments and delaying things, and baseball just came out and said they're delaying their spring training. And so, no, I'm not surprised. Anytime there's going to be a group of people together, even though, you wouldn't think that something like this would happen to the CME because they're such an integral part to the financial system. Not surprised, but, just like everything else that we've seen, too shall pass. So eventually I do see them opening the floors again. It's just, who knows when. It's a matter of when, I don't think if.
This is usually the part of the show where I ask Sean whether he wants to go light side or dark side, but you're our hot seat guest this week, Mr. Jeff, so I will give you the pride of place, sir. A lot obviously moving, a lot obviously shaking in our movers and shakers for the week report here, Jeff. So where should we start? Should we start on the, shall we say, fairly anemic upside? It's kind of hard to find 5 names that are even in the green this week, but we did it. Or should we start to the much more extensive dark side, Mr. Jeff? Where should we start?
Let's start with the dark side, just because we've seen such a big drop in oil this week. Early 90s was the last time we saw such a dramatic fall in crude oil prices. And so that's obviously on the minds of a lot of people. And you've seen crude oil, Brent crude get whacked, and other products in that space have definitely taken a hit as well. Gasoline, heating oil, you name it. That whole side is taking a beating right now.
All right, Jeff, giving away our whole dark side here, but let's get to it. Our dark side, of course, you guys can run the reports for yourself for this and for all the other products we're going to talk about here on the show. CMEgroup.com/TWIFO, TWIFO is the place to go to generate those reports for yourselves, not just during the show, but all week long. Those links are always live, so you can always go there. If you're thinking, hey, what's up in corn today? And I want to go type in that report, CMEgroup.com/TWIFO. They got you back there. All right, let's head on over to the dark side. Like I said, the whole chart, if you could see it here, listeners, it is pretty much almost entirely dark side. Actually, let's see here. 1, 2, 3, 4, 5, 6, 7, 8. Actually, we do have a total of 10 names that are just ever so barely in the green. So we could have done the top 10, but it's just squeaking out. Everything else, listeners, on this chart is to the dark side. We're only going to do 5, otherwise we'd be here all day. Number 5 to the dark side, Mr. Sean. I think you know this one, the E-mini Russell 2000. Once again, leading the charge to the downside here this week. We got some listener questions and other things about that. We're going to get into that in a few seconds here. But the Russell 2000 off over 23%, 23.3% since our last show day. Not actually our last day when Sean and I did it earlier, but actually our normal show day of Thursday. So off 23% since then. Number 4, pretty much the rest is, you can probably guess it, heating oil off 24%, palladium off 24.4%. Bad week for palladium. Bad week for the metals, too. We'll get to that in a little bit. WTI off nearly 32%, 31.8%. Who would have thought, on top of all the weakness for global demand, we'd be coming into this week and seeing a price war to the downside in crude. It's just mind-boggling what we're seeing out there. We were talking just on our last show about, wow, it seems people are really getting into those 40 puts. That seems like an aggressive hedge, but that 40 level, beyond that is where the shale oil producers really start to have problems. And lo and behold, a week and change later, and we're threatening the 30 handle to the downside. Whoever would have thought such madness would unfold? That's why we are indeed in such unprecedented, indeed historic times. And rounding out the dark side, number 1 with a bullet to the downside, the RBOB gas off 41.3%. So just rough times. We got to start in equity land, though, because A, Sean has to go in a little bit, so we got to get him on first. And also B, because equities are just taking up so much of the oxygen in the room right now. Of course, We are pretty much in bear territory now across the board. Actually, everyone talked about the Dow starting off this whole bear trend and killing the bull officially a few days ago. But actually, they forgot about the Russell 2000. The Russell 2000 actually beat the Dow, kind of an inauspicious title, but it beat the Dow to the downside by 2 days, actually. The Russell 2000 moved into a bear market faster than pretty much any other major index out there. In the last month, we're seeing the Russell 2000 off about almost 21%. At that same time, we saw the S&P at that same period. At the time this was done, I think this analysis was a couple days ago, 17.5%. So it had outpaced it to the downside out there. Of course, coming into showtime, we've seen just dramatic moves out there in the market today. A circuit breaker is triggering yet again for the second time in a week. Again, another pretty much historic development right there. Not doing a lot to stem the red on the screen. We had the Fed actually stepping in with some historic action as well, trying to jazz up, gussy up, save, if you will, some of what's going on in the Treasury complex with some repo intervention, about $1 trillion coming in there. That briefly stemmed the bloodletting. And then not so much. Most of the major indices back off again today. The S&P off nearly 8%. The Dow off nearly 9%. NASDAQ off about 7.5%. We're seeing similar levels for the Russell out there. VIX coming into showtime is at about a 65. The VVIX, a.k.a. the volatility of volatility. Actually, by the way, VIX, that's up 34 handles, listeners, from our last show just last week. Again, as I mentioned to Sean, how a week changes things. VVIX up 40 points. 4-0. From our last show. The volatility of volatility up 40 points. Just, I can't say that enough. And then RVX, a.k.a. the VIX of the Russell 2000, 67.5, almost up nearly 35 points from our last show. So small cap vol is feeling it along with everything else. That VIX RVX spread has actually widened out. It's out to about 2.4%. That's about exactly 1 point wider than it was this time last week. So it was kind of almost non-existent last week. But again, this is kind of speaks to the old adage, when it all hits the fan, correlation tends to move to one. We're seeing that now in supposedly inversely correlated assets now like gold and others starting to sell off. Again, the old saw, at the end of the day, when you want something inversely correlated, volatility is kind of your only friend, particularly equity volatility. And we're seeing that play out right now. Before I get into some of these other data points and everything else, let's start with you, Sean, because this is your bailiwick that you spend your days when you're not talking to me out there talking to folks about all things Russell 2000. Russell 2000 leading the charge to the downside yet again, sir. What are your thoughts on that move as well as just the historic developments we're seeing in the equity marketplace right now, sir?
I thought I'd start off with an anecdote that I heard from our very good friend from CME Group, the global head of equities there. It's Tim McCord, and he kind of referred to volatility. You know, a couple of glasses with a wonderful dinner is fantastic, but the more you drink, the less it is just a good wine and causes headaches. So I think we're at a point where we should kind of put the red glass down and let's focus on the markets here. But and speaking in regards to small caps, you know, it's small companies, right? It's small domestic companies, and there's not a surprise when there's this big, strong campaign for companies to let employees work from home. You know, small companies where there's a lot of client-facing kind of activity, and so I think it's pretty obvious that these companies are the ones that are going to probably create the biggest move to the downside during this. But you also have reasons to keep an eye on small caps during this, because I think Secretary Mnuchin mentioned that he's looking to create some small business incentives to keep companies going. I know a lot of that is being talked about on the Hill. So I think that there is a lot of interesting things that could happen. And something else to think about are the components and the segments of the Russell 2000. You know, it's heavily weighted in financials. So I think you got financial firms that have kind of taken it on the chin within this index, which has really exacerbated the downside. But, you know, Russell 2000 is that small cap engine that can. So keep your eye on small caps. Now talking about futures, I think in futures and options, the liquidity on CME Group has never been stronger. They're averaging 350,000 contracts a day, and you can't have a better experience getting in and out of the market when you would need to than trading at CME Group or CBOE in their run options. So I know our exchanges, and I actually heard an analyst talk today about the ability of exchanges to handle this unusual order flow, which has just has really been incredibly large, that there have been no hiccups and no operational difficulties either on the trading side or on the clearing side at these exchanges. So our compliments to them for keeping the machines running effectively.
Yeah, kind of an unheralded thing. People just expect the markets to work in times like these, but the fact that they do, and they survive these unprecedented volume levels we're seeing at CME and at other exchanges over there on the options front, certainly is a bit of should be a bit of a feather in their cap. It's like the old offensive lineman in football. When he does his job right, you never hear his number called out. You only hear about it when there's issues. And so the notion that things are going well out there, and volume, at least for the most part, still being managed without any sort of massive meltdowns system-wise across the board, is certainly, I think, worthy of note. Jeff, same question for you. First off, how much of your clients and users over there, Simply Derivative, how many of them are trading on the equity option side? And then B, what are your thoughts on whether it's small cap vol or large cap, or just the general explosion of volatility we're seeing out there in the equity landscape right now, sir?
Yeah, I mean, what we're doing and what our members are doing as we're trading, we're technical traders, so we've been watching the markets going back a month and a half ago, and we were positioning ourselves in the VIX for an explosion upward. We actually had bought some 20 calls in VIX, and they've done pretty nicely, as you can imagine, that we're sitting at a 65 handle in the VIX. In equities, options, we were selling actually some puts as the move had been going down, but you get to a point where it's just no longer a viable strategy. So you kind of have to sit in cash, or if you want to take the other side of it, you can buy some puts to protect yourself to the downside if you're not outright trading these equity index futures themselves. And that's kind of a combination of what we've been doing: long VIX, long bonds, long gold, and then mostly cash and a little bit exposure to the equity side. But, we've been really seeing these swings to the downside and upside, really. And a lot of our members and clients haven't really experienced this type of volatility. So it's somewhat of a new trading environment for a lot of people. And so, I'm just trying to do my best to make sure people are staying calm and reading the charts and following their plans, really.
Yeah, having a plan is key in these environments, and certainly sometimes the plan can be to go into cash if you can't make heads or tails of what's going on. Be patient, be diligent out there. Just rushing in because you see an opportunity these are not exactly the times for rushing in. Speaking of rushing, Sean, I know you have to rush out pretty soon. Things are obviously pretty busy over there in FTSE Russell land. But before you go, I wanted to cheat and actually bump up a listener question because it's right in your neck of the woods, and I'm kind of curious about this one as well. I've kind of been doing some digging of my own on this topic. This comes from listener Selamy. Selamy wants to know, why are the small caps being hit harder than the large caps in the coronavirus stock market sell-off? And Sean, this goes back to an old adage, an old bit of accepted wisdom about small caps that, they are supposed to be somewhat isolated from these large macro trends that buffet the rest of the market, particularly the large caps. Yet lately, of course, it's been exactly the opposite. As we just pointed out, small caps are leading the charts to the downside week after the week, and they have done so yet again. So I'm curious, Sean, I know you're obviously talking to the research folks and everyone else over there at Russell on a daily basis. What are your thoughts here for Selamy on why you think small caps are leading the charge to the downside yet again, sir?
They're smaller companies by nature. A lot of them are service oriented. The index itself is heavily weighted in financials, which I think I mentioned a few minutes ago, which have really kind of exacerbated the downside. But let's get this into option kind of discussion. And as we all know, that there's always been a skew to the downside puts of of the Russell indexes where there's been this, obvious trading opportunity in a bullish market to harvest volatility trades and writing puts. And because of that skew, and that skew exists because of this nature of this index, right? So there is a sharp downturn in small caps when there is a downturn. And this is a perfect example as to why that skew exists. Feel free to add there, Mark, but I know this is something that we always talk about is why is there such a sharper skew here? And we know that there's the need for this downside protection, and there's also this desire to harvest volatility. And of course, right now is not a time to be just out there or slinging. You really have to be very careful with your trades and know your entry points and your exit points on a very disciplined basis. But again, the index is a volatile one. We talk about that a lot on the show. And as this market continues to evolve, I think we're going to continue to see this type of volatile behavior in the small cap region. But in the small cap segment of the market, I think it's something you need to be watching carefully as this market comes down, because I think, again, as the liquidity is so great in the futures and options on our exchanges, there's a great trade opportunity there. So keep your eye on small caps.
Speaking of exit points, this is yours, sir. I know you have to run, but before you go, you want to leave our audience, if they have more questions like Selamy, or perhaps they want to just find out more about what you guys are cooking over there in FTSE Russell land, where should they go? What should they do, sir?
They could reach out to me at smith@FTSERussell.com. They can go to the CME's website. There's lots of information in regards to Russell and small caps there. But FTSERussell.com is the home for all the small cap information that you would ever need. And if you're having trouble navigating our website, just reach out to me at smith@FTSERussell.com, and I'd be happy to share any and all information regarding Russell and any of our FTSE Russell products with you. So with that, I'm sorry, but I do have to hop.
There he goes. So smith@FTSERussell.com. He's giving you his email directly. I've warned him against that, but hey, go for it. Hit him up with your questions, your comments here. He's generous enough to offer that up to you guys if you have questions as we head on out. A lot of things lighting it up out here. We got to head off of equities really quickly before we do. Just want to leave you with a couple historical nuggets in case you're on the ledge, you're panicking right now. Good to put things in historical context. Goldman did just that. They studied a bunch of bear markets going all the way back to 1835. A few notes. They broke them down into three different categories: cyclical bear markets, structural bear markets, and event-driven. I'll let you guys guess which one we're in right now. Of course, event-driven. Some of the maybe worst news is that event-driven sell-offs usually result in somewhere around 29 to 30% sell-off, so we have a little bit more to go on the downside if that is the case. Good news, though, these types of markets that are driven by these exogenous shocks, things that are outside the system, they usually regain their previous levels within 15 months. Again, we've never had a pandemic-driven sell-off like this before, so that in and of itself may be a little bit different there, but still, if you like data points, that's a helpful one for you. If you're curious, structural bear markets, those are obviously when things are bad, the entire economy, the structure of the economy is shifting. Those are drops of 57%, so those are pretty bad. The cyclical bear markets, we're kind of just seeing the end of one trend, the beginning of another. Those are drops a similar level to the events, around 31%. So if you're curious where we fall right now, that's how we're stacking up. But we have to keep on rolling some other products, get them on the table. As I mentioned, pretty much the entirety of our dark side of our movers and shakers this week is energy. We had RBOB, WTI, heating oil, everything over there on pretty much the top of the bottom five, I should say. Most of it is energy. So we got to start with our good old friend WTI. Oh, what a week it has been. Like I mentioned, who would have foreseen Russia and the Saudis/OPEC getting into a price war over there? You know, Saudis and OPEC trying to get Russia to agree to some production cuts to kind of hold off on some of this continued downside. Russia saying, yeah, no, we're actually good with these levels, trying obviously to squeeze out U.S. shale producers, and the Saudis saying, okay, sure, we'll see you and we'll raise you with the price war and more production increases. So as a result, we've seen WTI and crude across the board get effectively annihilated. Coming into the middle of the show here, we're seeing WTI at right around 31.5, 31.40, so rebounding from its lows, but still off just a huge annihilation. Just for this week alone, it's off about almost 24%, and since our last show, off nearly 32%. Jeff, I know you mentioned you trading some crude out here. Obviously, we're seeing some interesting developments out here. I'll get into the vol and the skew and all that in a second. But first off, what are you hearing from your clients and your users out there, and what are you seeing out here in the broad energy markets right now, sir?
Well, for a while, we had been trading above that 51 level, 50 to 51 in crude for quite some time. And, when prices had come down after peaking out at 65, if we got back down to that 50, 51 and saw a break below that level, we were talking about seeing a further push down to the 40s in crude oil, and that's exactly what has played out. So, we've been looking to get short crude and have taken shorts in crude for the past several months. Obviously, we didn't expect this to the downside and this speed. And so, profit taking has come a lot quicker on these type of trades. But in terms of the technicals, we were looking for a break below that 50, 51 area for a move down to retest that 42 handle. And we've definitely gapped below that. So I wouldn't be surprised, and we've been talking about this with our members, we wouldn't be surprised just because of what's going on in terms of the virus and what it may do to business and industry, on top of the fact what Russia and the Saudis are doing. They're increasing the supply. The demand may come in a lot more than we think. And if that's the case, it's just basic economics at that point. You're increasing the supply, you're decreasing the demand. So where does price have to go? Price has to go lower. So we wouldn't be surprised if we saw crude oil dip below the recent low that we just put in at 27.5 and retest the low 20s. And so that's kind of what we're waiting for and looking at. Now, if the 30 handle can hold, don't be surprised to see a snapback back up to the 40s. But that's more of a technical perspective. And, going back to what I said a minute ago, in terms of the fundamentals and what's going on in big picture, like I said, we may see crude oil get to the low 20s before all of this is said and done. So that's kind of the game plan with crude and what we're looking at and what we're trying to do.
Let's see what's going on out here in the broad WTI options market. Again, you guys, as always, can run your own reports, cmegroup.com/TWIFO. If you're doing that, head on over to the energy drop-down, select WTI, and then you're off to the races here. Again, we're seeing vol, as you might imagine, up firm, I think is a technical term, just quite a bit. All these contracts, especially within a couple of weeks to go, up about 60-plus points, which is just insanity. Again, kind of goes back to what we've said before. Crude, more of a vol product than people often assume out there, even in some of the more stable contract. Let's go out to DEES, where there also was some interesting paper out here this week. The DEES contract up 12.5 points from a vol perspective out here right now. So almost a 47 out there from an applied vol just in the DEES contract alone. So pricing in some vol throughout the rest of the year here in WTI. If you're looking at where the action was this week, actually, before we even get to that, let's look at some of this. Well, no, let's look at where the action was actually first. That was lion's share in the April contract with about 5 days to go. That's about 33% of the paper out there this week. And of that, the big print was the 30 puts. These bad boys doing 23,000 contracts, a big day on Monday. Go figure, that's when we kind of first came off the heels of the announcement of this price war, effectively, in crude. We saw the markets limit down for the first time. As a result, we saw 12,400 of the 23,000 going up on Monday. The rest kind of equal. Today, actually fairly light, only about 2,500 contracts on the tape of these 30 puts in April. So, you have a few days of shocks. Maybe the market getting a little bit in year to it, 4,000 each the rest of the days. Number two, actually, it's not all puts all the time. There are some calls, and we'll get to that more in a little bit. It's the 40 calls also in April. Number two out here this week, nearly 21,000. The big day, actually Tuesday, 7,000, when we saw a little bit of that move off the lows there on Tuesday, folks. It's like piling into some calls. I should mention both of these are substantially opening. The calls even more so than the puts, about 2x opening on the calls versus the puts. Obviously, a lot of back and forth on these strikes this week as well. Today, only about 3,000 contracts on the tape for these 40 calls. But still, all you're thinking, it's all downside all the time. Maybe a little bit of that rebound we saw earlier this morning. And as a result of the Fed, maybe that's also driving some of that call paper out there. Then number 3, we actually have a tie with the 32 puts in April doing about 15,300, as well as 15,300 of the 45 calls out in Dees. So again, all of you thinking this is just a near-term sell-off play, and that's certainly what it has been. But there is some longer-term upside paper going up out here, in particular the Dees 45s. Pretty active, tied for number 3 this week with about 15,500. So actually, they're the slight lead, so they actually would be number 3 versus those puts we just talked about in April, with a big day coming on Monday. 6,100 of these Dees 45s going up on Monday, kind of evenly split the rest of the week. The second biggest day was about 4,800 on Wednesday. Pretty light today, only about 2,500 on the tape. And again, a good chunk of that, about a little more than a third, actually opening this week. So a lot of opening upside paper. Dees 45s, maybe some folks, and this kind of goes back to a talking point we've had for over a year now on this show, is, when will we see an inflection for some interest, some love in the call wing out here in WTI? It certainly hasn't been lately, because it's been all downside all the time. And every little blip we had, whether it was the assassination of the Iranian general, whether it was the drone attack on the Saudis last year, both of them were just short, minute blips to the upside before everyone just faded it. Every guest you've had on here from the crude markets has all said every upside move has been just an opportunity to fade. And that's pretty much what we've seen. Well, let's see if this week if there's been any change to that narrative. We could talk really quickly some skew in this April contract, even though it's only going away in 5 days, so I'm kind of leery about that. Let's look really quickly. Yeah, the puts got a little bit more bid out here, and the calls got a little bit more offered in the April contract. But again, only 5 days to go. Kind of hard to parse. Let's go out to Dees. I'm kind of curious what's going on out there in Dees. That's longer-term paper, a little bit more level-headed paper, easier for me to say. Let's see. The skew out here in Dees, the puts were 14.6% rich to the at-the-money last week. So clearly a pronounced bid to the put. This week, coming in a little bit. Go figure. We've blown through some strikes, down to about 9.6% rich. Still rich, but not quite as rich as they were, off about 5 points. And the calls last week were 9.5% cheap to the at-the-money. This week, a wee bit less cheap. Not going to say they're bid, because they're not, but they've come up about 2 points. They were now the 7.5%, I should say, cheap to the at-the-money. So the call's still cheap, put still bid, but less so on both of those. That's also because we have just some extremes out there in the calls out here, and involved just in general. So some fascinating stuff. I encourage you, check that out for yourself here. We could spend a lot of time here on energy as well, but I want to keep on moving, get some other products on here. Another one that's been, I think, surprising a lot of you out here has been what's going on in the metals category. The old narrative is gold, flight to quality, right? That's where everyone goes in times of panic, times of trouble. And yet what we're seeing this week is kind of a little bit of the other old narrative, which is, like I said at the top of the show, when it all hits the fan, correlation goes on. That's why I've said many times, you want to have some vol in your back pocket for times like these, as opposed to your usual traditional sources of diversification, because they're probably going to disappoint you in times like this. And guess what? That's exactly what they're doing right now. We're actually seeing gold off firm today, actually for the week here now. We're seeing gold off nearly 6%. So a rough week. Again, it started off strong. We saw a big spike in gold as we came in, lock limit down on the morning there on Monday. We saw gold have the rally you'd want it to have. It surged over 1,700. That was the first time since 2012 we've seen levels like that in gold. So the week started off with gold doing what people wanted to, but since then we've seen just I think the technical term is a drubbing out there. We're seeing it off gold now off net nearly 6% from those crazy levels here, off of 95 or so handles. And just annihilation out here, which is not what you want to see when the broad equity indices are off 6-7%, that your quote-unquote hedge portion of your portfolio also off, at least on the week so far, 6% here. And that's not exactly what you want to see out there. Jeff, I know you guys mentioned you do some little metals out there too. What are you seeing from your clients out there in terms of metals? Are they disappointed by this move? Are they trying to trade it up? What are you seeing out there on the metals side, both in the markets and what you're hearing from your community there?
Yeah, no, anytime we have volatility, it's going to be good for us technical traders or short-term traders. And so, once we got that spike back up above 1,700, we were looking at getting short gold. And to your point, that old adage where gold is usually a hedge when equities, get hit hard. When it's crazy times and the markets are in crash mode, everything goes down, and gold is no exception. You can go back and look and see at any time when equities really took it on the chin, gold definitely got hit as well. Ended up rebounding as equities continued to move lower, but gold, just like anything else, is not the true safe haven that everybody thinks. And to your point that you said earlier, getting long volatility is really the best hedge for equity exposure if you're long equities. So for gold, like I said, we've been trading it on the long side for the past few months. We've enjoyed a nice run up, but it got to levels that we hadn't seen for quite some time. And when markets get to levels that they haven't seen in quite some time, there's can be a reversal. And that's, what we were banking on and kind of took advantage of. And so as gold had spiked up, we were looking at selling call options on the futures above 1,700 strike, and was hoping for a pullback to this most recent swing low. And this 1560-ish area that we're at now is going to be a pivotal spot. If we break below that, I think we're going to go test 1,400. If we can stay above that, don't be surprised to see gold back up above 1,700. And I know it's a whipsaw trade, and the markets are all over the place, but the times that we're in are, quite unique. So you just got to be prepared and make sure you are following your plan. And I'm going to keep saying that because most people don't have a plan, and they don't know even how to have a plan. And so getting educated is step number one.
Definitely. Education. Big fans of that here on the old program. It's one of the things we try to do here week after week. Inform, educate, hopefully a little bit of entertainment in there as well, answering your questions. And in times like this, probably providing you a little bit of perspective is also helpful out here. Let's give some perspective on what's trading right now out here in the gold options over there on CME land. Like we said, they're off quite a bit here coming into the show. The vol, as you might imagine, that's been another narrative on the show for quite some time. Gold vol has been fairly anemic for the better part of the last year outside of a few spikes, and we're seeing one of those spikes right now. Gold vol up pretty strong right now. The big month out here is April, doing nearly 40% of the paper this week. April has about exactly 14 days to go, so falls right under our wire there for looking at it from a skew and volatility perspective. And the vol out there up about 8 points to about a 31.25. So it's been a while since we've seen gold hitting those frothy levels out there. So all of you out there who've been saying, gold vol is anemic, there you go. Here's a nice little blip for you on the radar. Let's look at the skew out here as well in April, because that's also where our number one trade was. That was the 1,700 calls, if you're wondering, listeners. Let's look at the skew out here. The puts were bid last week, 3.4% this week. Puts have come in. And again, that's not exactly surprising. We saw the rally, and now we've seen this downside, so we kind of broke through upside strikes and then downside strikes. That's going to wreak a little havoc with your skew, and we're seeing the result of that. The puts coming in now, they're 8.3% cheap, so about an 11-point swing there from a vol perspective on the puts, as we kind of have been crashing through strikes now on the downside. To the upside, we saw the calls last week were about even to the at the money, almost 1 point cheap, so not quite even that level. And this week, calls are bid 13.6% rich, so that, again, that's probably reflects the rally we had through 1,700 and then the immediate return through it. You might have expected some of that vol to come in as we retreated back off those strikes, but it seems like there still is a bit of a firm bid. Again, this is a contract with about 2 weeks to go, so you're getting more towards the gamma side of the equation rather than the vol side, but still, there's enough in there to read into what's going over the next couple of weeks. Like I mentioned, the big trade out here this week in gold options, 1,700 calls, number one with the bullet, doing 12, nearly 13,000 contracts, a big day. Surprise, surprise, was Monday, about 4,200 contracts, about 3,300 on Tuesday, 3,800 on Wednesday. Today, again, fairly light, only 1,300 contracts. Most of this paper this week actually was closing. So whether it was people fading the upside, then we broke through 1,700 and they're getting the heck out of Dodge, or they had their specs on, we broke through the 1,700 strike, and then they closed it out. Either way, tons of closing paper on the 1,700 strike. Hopefully, I'm going to be optimistic. Hopefully, I'm going to assume that was everyone had long calls. They dumped them as we broke through, and now they're laughing all the way to the bank. But probably not, but we can be optimistic here on the show. Number 2, right behind it, are the 1600 puts, also here in April, doing 11,200 contracts this week. The lion's share coming on Monday yet again, about 3,400, and the rest kind of evenly spread throughout the week. Again, kind of like today, about 2,200. And net opening on these puts. So as we're retreating back actually through that 1,600 level now, and as Jeff maybe alluded to, if we keep surging lower, we might be testing the 1,400s again. We'll see. But right now, the 1,600 puts leading the dance with number 2 here, 11,200 of those on the tape. Really quickly here, 1,800 calls. So if you were in the bullish, super bullish camp, you weren't alone. About 7,000 of those going up this week. Obviously, most of them on Tuesday. So I guess as we retreated off those levels, folks came in and closed out quite a bit of those. So interesting paper there. Let's look out really quickly. We like to look a little bit farther out in gold as well to see if we see any aberrant prints. Let's see here. We've got May 17 halves. That isn't that surprising. 17 halves are pretty popular in May and in June across the board, doing about 5,000 and 7,300 respectively here. So decent paper for those. Farther out, you go all the way out to Dees. Somebody was playing in the 2000s. The 2000 calls doing about 3,500 contracts. The lion's share actually today, about 1,300 going up today, and the rest kind of going up throughout the week. Looks like a chunk of those were closing, but not all. So maybe someone taking some off when we got through the 1,700 strike, decided that was as close as we were going to get. Either way, interesting stuff. Also worth noting, the 2,100s and 20 halves were going up this week. So 3,500 of the 2000s, 1,300 of the 2,100s, and about 1,300 of the 20 halves. So maybe a 2,000 20 half, 2,100, a funky fly, perhaps with a bit of a 2,000 or a 2,100 kicker. Either way, funky stuff. Actually, no, it's worth noting the 2000s traded all week, whereas the other ones just traded sporadically. So those don't appear to be related, even though they might at first blush seem like they are. So that's what's going on out here in metals land. Again, we can sink our teeth into a lot of metals. Really quickly, the other precious metals also underperforming this week. We had platinum declining over 7%. Palladium, like we mentioned, getting annihilated this week, down 22%, had its biggest daily drop of 11% since 2008. Earlier this week, silver getting annihilated 5.3% in a single day. That was down to its lowest level since July of last year. So just across the board, platinum on track for its worst day since December of 2008. We all know what happened back in the heady days of 2008. So again, correlation going to 1 when it all hits the fan. So something we've mentioned here many times on the show, listeners, and unfortunately it is playing out right now. I say unfortunately because I know a lot of you like to use the metals as a core hedge in your portfolio. Another area a lot of you like to diversify to is the rates, and we've certainly seen some action on that front today. Of course, kind of a double whammy out here. First, we saw the ECB perhaps not going as far as some people thought, coming out and saying they were going to provide stimulus, similar to what we saw here in the U.S., but not matching the rate cut that we saw in the U.S., maybe because they saw the Fed didn't really have the result that they anticipated there, so maybe deciding to save their bullets. Kind of hard to argue with that, although they are approving more stimulus measures to help their economy with rates staying unched. Kind of weird. Fed following hot on their heels, saying they're going to pump in over $1 trillion to help that effectively that repo market. Still, that seemed to mitigate some of the sell-off for a little bit, but not enough. The market now just turning right back around to the downside. Jeff, you guys do a lot of fixed income over there at Simply Derivatives, and if so, what is lighting up your tape out there these days, sir?
Yeah, we definitely do. We take advantage of the futures markets outright themselves, but also enjoy playing the options. And going back a couple months towards the end of January, when we had put on our hedges and our directional bets in the VIX, we actually, about a week after that, we saw a nice opportunity in the 10-year, and it showed up in the other markets as well, the 30-year, the 5-year, and the 2-year. We actually went out and bought some 132 calls in the 10-year that expire in about 15 days. And so those have done nicely. We were basically waiting for a gap to get filled after a pop in rates or in futures, on the bond side. We got a gap up towards the recent highs with a little bit of a pullback into that gap, and that's when we got long and expected to see the 10-year and the 30-year go higher. Go this higher, we didn't expect that. This is obviously a move that you can't really expect in any market to have this type of event-driven mania right now. But, like I said, we're technical traders. We're watching the charts. We're not watching the news. We saw that, bonds were going up. We had a slight pop towards the highs with a pullback, and that was our opportunity to get long. And with that, you're obviously going to see yields come down. And so that's how we've been trading bonds. We've been long for about a month and a half, going on 2 months now.
Well, Jeff, as our guest, we obviously have to dig into the rates. Eurodollars, as I mentioned at the top of the show, leading the dance to the upside this week, up 30.6% since last week's show. So a little bit of a different frame of reference, not just on the calendar week. On the calendar week, a little bit more muted out there. But still, Jeff, where should we hang our hat next in the rates complex? Should we do Eurodollars? You want to do the 10-year or the 30-year? I'll leave it up to you, sir.
Let's tackle the 10 and 30-year. Why not?
All right, 10-year. Of course, I had the Eurodollar up here, so let me just switch my screens here. Of course, listeners, you guys can do it yourself as well. CMEgroup.com/TWIFO. Then head on out to the rates, and then select from the drop down the 10-year. You'll see exactly. We don't get to talk 10-year a lot here on the show, and actually, it wasn't even in our top 5. It was the 30-year. But we're sneaking the 10-year in anyway, because why not here? Again, off about now net on the week here, about 0.5% coming into this calendar week. Net on the show from last week, a little bit of a different perspective. Vol, of course, up across the board. The biggest action out here this week was in the April contract as well. That has about 15 days to go. The vol on that contract up, but not as much as you might think, up about 1.3 points out here, right about exactly a 12 out here from the vol perspective. We're at about a 137 almost even out here from a strike perspective, listeners. And again, the big print, before we even get to that, let's look at the skew here really quickly. The puts last week, 10.4% cheap to the at-the-money. This week, they're nearly 17%. So the puts getting cheaper, and the calls were 17.7% rich this week, 22.3%. So calls getting more bid, puts getting cheaper. Not surprising as we're seeing some of this event risk playing out in the market at these just kind of unprecedented levels out here right now. In terms of where the action was this week, it was almost, actually I take it back, it was neck and neck. It was close with the April 140 calls with 44, almost 45,000. But the actual volume leader is out here in May, where we're seeing 46,000 of the 135 puts, so neck and neck. Actually, no, as I dial it back, as I scroll down more, we see even more out here in June, 87,000 of the 134 puts. So even though the most aggregate paper, 37%, was in April, the biggest print was actually in June. Don't see that too often. Again, it was the 134 even puts. These are about 3 points out of the money right now. About nearly 88,000 contracts, the lion's share. 36,000 on Monday, 24,000 yesterday, 16,000 Tuesday, 11,000 today here. And Jeff also asked for the 30-year. Never let it be said that we are not obliging here on the old TWIFO program as well. Again, switch that drop down to the 30-year, listeners. Select all if you are a brave-hearted soul, and we'll dive in here. The 30-year right now at about a 177, almost even out there as well. Net on the week, it's off about 1.5%. Of course, 30-year from our last show was up, coming into the show, was up about nearly 4% net from last week. So, oh, how the worm has turned out here in the rates complex in terms of where the action was out here. Also in April, also with 15 days to go, it was the April contract doing almost 50%, 44.5% of the paper this week. Vol, as you might expect, up pretty firmly, up about 4 points to nearly a 28 out here in this April contract. Skew-wise, the puts 10.1% cheap to the at-the-money this week, 15.1, so coming in exactly 5 points. Or I should say getting cheaper, exactly 5 points. And the calls unched, 18% rich last week, 18% rich as of right now. So that is somewhat surprising. What is the big print out here? We have, 175 even puts. These are a little over two handles out of the money puts right now, doing about 9,000 contracts. So the biggest print out here, actually not as large as perhaps you might think, only 9,000 contracts. Now compare that to Eurodollars that will easily do 900,000 on a particular strike. So 9,000 here. But again, this is the 30-year, so a little bit different frame of reference out here. Again, the 175 even puts 9,000 of those leading the dance. The biggest day actually was Monday, about 3,500. The rest kind of evenly scattered throughout the week. And a lot of back and forth on that strike, slightly closing net on the week out here as well. We could do a little Eurodollar as well, but I want to make sure we get a couple more of you here on the program as well before we have to wrap up. So without further ado, let's head on out to your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, we're coming up against it. I want to make sure you guys get a little bit of time on the show here. First off, we got some love coming in from TL Diamond. TL Diamond says, love my TWIFO. Well, right back at you. We love you and all the folks out there who listen. Great show, he goes on and says. Maybe you need to extend the show to 2 hours during these markets. I would love to hear full rundowns of all the product complexes, including ags and FX, and even weird ones like dairy. Hard to squeeze all of that into an hour. Yeah, I'm with you, TL Diamond. Problem is we have other shows going on the network we have to get to. And also, as you see, people are busy doing their actual jobs in markets like these, so we couldn't even have Sean on for a full hour. So it's a little challenging to extend it to 2 hours, but I do see where you're coming from. We would love to do a broad sweep of activity across all the complexes. I mean, clearly there's a lot of complexes lighting it up over there on CME every week. We kind of have to pick and choose and filter a little bit, hence the name of the show. It's kind of what we're talking about here. But yeah, maybe someday, maybe there will be a massive 2 to 3 hour extravaganza of TWIFO where we're breaking down everything. We'll see. Keep your fingers crossed. We love the love, though. Keep that coming. Let's wrap it up here with Colby. Colby wants to know, with gold down, is now a good time to buy? Would it be better to buy options on gold? Well, Jeff, you're our resident technician here, and you're just talking about gold. I have a feeling I know what you're going to say about this, but what do you have to say here for our listener, Colby? Are you confident in gold at these levels? What are your technicals telling you, sir?
Well, it's a great question, and it kind of goes back to, what that individual is doing. Are they using gold as a hedge? Although, in these type of market environments, it doesn't really do that for you. Is it simply speculation? Are you just trying to, catch a bounce in gold? Now, options on gold is an interesting way to get involved in this particular market, and it allows you to be wrong more so than if you were just going to take a directional trade. And what I mean by that is you can buy, let's say, call options going out a couple months on gold. And if it does go down a little bit further and settles above that 1,400, 1,500 area, depending on how far out you went, you may still be in a position to take some profits down the line as gold rebounds and recovers back up to the 1,600, 1,700 strikes. And so using options on it may be a better way to do this if you're not exactly sure on the timing of it. Right now, I particularly wouldn't do anything at the very moment. Like I said, this 1560, 1550 area is somewhat of an important level to pay attention to. If we drop below 1550, I wouldn't buy gold. I'd wait for a bigger move down closer to below 1500. If we stay above this 1560 and you see some bids coming in, then you can definitely hop on board and take advantage of a ride that would potentially take this thing back up to 1700 or much higher, especially if, given what's going on, continues to last for, some time, and we don't know how long this will last. but, getting into gold may not be a bad idea.
All right. That music, listeners, means we'll have to leave it there in spite of your request for more hours on the show. So far, it's still only one. But before we go, Jeff, you're our guest in the CME hot seat this week. If folks are intrigued, maybe they have more questions like Colby and others did about certain levels, in particular underlyings and how to trade them. Maybe they want to reach out to you with more questions. Where should they go? What should they do, Jeff?
Yeah, absolutely. You guys can feel free to send me an email to jeff@simplyderivative.com. You can also visit us at simplyderivative.com if you guys are interested in learning the technicals and using charts and adding that to your tool belt, if you will, in terms of trading in the market. Then definitely check us out at simplyderivative.com, or you can email me anytime, jeff@simplyderivative.com.
You're a brave man using the D word, the dreaded D word in your title, sir. There's a reason why we don't call it the Derivatives Insider. It scares the hell out of people. But I see you're boldly going for it, sir. So well done to you. You're a braver man than I. SimplyDerivatives.com is the place to go. And, of course, Sean mentioned already, you want to check out all the stuff they have in terms of research on small cap and volatility, what's going on. The equity front, premium harvesting. I know you guys like it, too. FTSERussell.com, the place to go, or give them a follow on the old Twitters as well, at FTSE Russell. And, of course, for all these reports and everything we're talking about, everything we're trading here, CMEgroup.com is the place to go. And on behalf of Jeff and Sean and our friends over there at CME, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in such great questions. I promise we'll get to more of them when we have our 2-hour show extravaganza. And we'll see you back here tomorrow, 1 p.m. Central, 2 p.m. Eastern for Volatility Views. Then we kick it all off again on Monday with the option block, and we're back here again on Thursday for more of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.